One of the things that we like to emphasize in the public banking movement is that our taxes and fees are our money. That's our money that we've given over to the government to pay for the services that we want. The government acts just like, you and I do, where we have a bank account, we put a surplus in there, we take it out as we need it to pay for stuff. Right now, we deposit that into private banks, and those banks are able to transfer those deposits into loans and then make money. So they're making money off our money. So our argument is, hey, why don't we make money off our money? Why don't we take that money and transform it so we can have lending to things that we need, and then profits won't be private, they'll be public, and we can use them for the public good.
What if the real question of sovereignty isn't about borders, but about balance sheets? For all the ink and airtime that I spend talking about soft secession, special autonomous zones, and state sovereignty, most of the debate and discussion comes down to something far more concrete: financial independence. Whether any state or region can truly chart its own destiny depends on who controls the money, who gets to create it, move it, and lend it. And like most policy innovations, the good ideas are already out there. From the Bank of North Dakota to the credit facilities in Vermont, to systems in China, Germany, and Costa Rica, laws are already on the books that reinvest locally, because public banking isn't a radical thought experiment. It's an old idea waiting to be replicated. If we can just cut through the thicket of rules, lobbyists, and financial interests that protect the status quo. Look, the fight over economic self-determination isn't new. Far from it. It's the same argument that defined the early republic. This is exactly what Jefferson was debating Hamilton. It was about farmers versus financiers, local control versus central command. And here we are again, facing our own inflection point on the West Coast, asking whether the money we earn, save, and tax could be put to better work for us. I'm Greg Amrofell, and this is Pacific Time. Today's guest, Marco Rossi, leads the Washington State Public Bank Coalition. And together, we're going to explore how public banking could give the West Coast a form of quiet, practical sovereignty. One rooted not in protest, but in the simple act of keeping our money home. And before we dive in, I want to let you know that Pacific Time is now live on YouTube, where you can find full audio episodes, playlists on recurring topics like healthcare, climate, and the economy. And you can also watch short video clips with my West Coast takes on issues emerging faster than I can produce a podcast, as well as finding video clips from the interviews. Visit @Pacific Time Podcast on YouTube. And please subscribe, like, comment, and share. Now, on to my interview with Marco Rossi, who started by explaining the concept of a public bank.
So what a public bank is a bank that is owned and operated by some type of public institution. And what we mean by that is some form of government. In a private bank or a credit union, how that bank operates is it goes out and collects deposits from individuals, who then pools those deposits and then goes and makes loans. A public bank kind of interacts in the opposite manner. So instead of going around and collecting deposits to come up with a big pool of money, what it does is it takes the taxes and fees that we all pay to our government and then deposits it into a public institution. And then I'll use that deposit as a way for investing and rearranging that deposit into loans for things that the community needs.
Got it. You're hinting at distinctions between public banking and the private sector banking world. Can you elaborate on that comparison? How does this look different, and what does private banking do that's not so much in the public interest?
There are a variety of forms of banking models that exist in the private sector. And throughout our history, we've had a panoply of different kind of charters for different financial institutions. And it's something that's constantly evolving. We're kind of having some institutions kind of die away and new ones form. Essentially, for a private commercial bank, how that operates is you have someone who starts a business and gets a bank license. Oftentimes, they will get shareholders to inject capital into that institution, and then they will go out and collect deposits, and then they will transform those deposits into loans. Banking is really mystifying for a lot of people, but I think what makes it more clear is when you think about a bank just operates like any other business. It, just like a car manufacturer or someone who sells jam or makes shoes, anything like that. But what makes it, I think, not totally intuitive is what banks buy and sell is money. Banks are in the business of buy and sell money. The interest that they pay on your deposits is the money that they buy from you. And then the interest you pay on loans is the money that they're willing to sell. And then the difference between those two is how they make profit. So a private bank that operates through a profit motive, they're going to try to maximize profit. Now, another private institution that you mentioned was a credit union. A credit union is a not-for-profit institution, so it's not there to maximize profit because there's shareholders, because it doesn't have any shareholders. It operates through a board, but it's supposed to be responsive to its membership. So it's formed to provide financial services to a particular demographic, a particular group. And part of getting a charter to be a credit union is you have to define what the population is you're serving. How are you going to determine your membership, all right? A public bank, as I mentioned before, is an institution that's chartered by a government that accepts the deposits of government and then loans out to the community, all right? A lot of them, even though it's possible, and there are some examples of it throughout the world, a lot of the examples we have in public banking in the United States is that it's kind of a bank for government. You know, your taxes and fees right now, those get deposited in a private bank. This would go into a public institution, and then you would have oversight into how that money is lent out. One of the things that we like to emphasize in the public banking movement is that, hey, our taxes and fees are our money. That's our money that we've given over to the government to pay for the services that we want. The government acts just like, you know, you and I do, where we have a bank account, we put a surplus in there, we take it out as we need it to pay for stuff. Right now, we deposit that into private banks, and those banks are able to transfer those deposits into loans and then make money. So they're making money off our money. So our argument is, hey, why don't we make money off our money? Why don't we take that money and transform it so we can have lending to things that we need, and then profits won't be private, they'll be public, and we can use them for the public good.
So, yeah, and this gets to a related question, which is what problems is public banking trying to solve in Washington State, Oregon, California?
So those are all states that have public banking movements that have had efforts to try to get the creation of a public bank, either on the local level or on the state level. What it's trying to solve is, I would say, two main issues. One is the issue of, I would guess, kind of sovereignty or publicness, and saying, hey, it's our money, we should have control over it, which is kind of an overall principle. The other more practical issue is making sure that capital gets to projects that serve social needs and social goods, all right? Throughout the 80s and 90s, up to the present day, we've had a historic phenomenon of banking consolidation that's unprecedented in our nation's history. We're seeing just a dramatic decline of banks, and small community banks, which did a lot of the lending, they are becoming fewer and far between. There are some people who predict that in the coming decades, they just may be kind of extinct as an institution. And we've had certain financial institutions that have essentially gone extinct. With the decline of sort of those small community banks and the consolidation of more and more into these mega banks, we are seeing a financialization of the banking sector, where a lot of those mega banks aren't doing the day-to-day lending that kind of makes the economy run. So they're not lending to small businesses. They're not, putting a lot of effort for mortgages. There's not doing car loans. And if they do, the interest rates are very high, which is very burdensome for people to do that. So the immediate need that public banking serves is, well, now we have a public institution that can fill that gap that's being created through the history of banking consolidation. And we can lend to the social needs that we have. We can make more affordable car loans and mortgages and whatnot. We could also lend to housing authorities or social housing developers to create new housing. The Bank of North Dakota, which is the example of public banking that we have in the United States, one of the ways that that bank has been really successful is that it lends out to small community banks and credit unions throughout the state. And so it kind of acts as a mini Federal Reserve because it gives them very favorable interest rates. Banks are just like you and me, where, if you run out of money, you have to go borrow. And banks usually borrow, even on a daily basis. So they are able to borrow from the Bank of North Dakota at a very favorable interest rate, and that helps them survive. North Dakota has more banks per population than any other state in the country because they have this built-in safety net system through the Bank of North Dakota. So we can help community banks, we can help credit unions, we can start getting money to projects that we want to see funded. Another really big one is infrastructure. Infrastructure in the United States after the World War II, we were preeminent in the world. We were a leader in infrastructure, and now we've fallen behind. And there's all this talk about a country like China is surpassing us. Well, with public banking, we can fund a lot of those infrastructure, and almost by definition, infrastructure projects kind of pay for themselves. So it's a very sound investment. We just don't have the financial sector putting capital to those investments because they find it more profitable to put money elsewhere.
Let me stick with this from the perspective of a consumer on the West Coast or a small business owner on the West Coast. On one hand, I'm thinking, gosh, everything you're saying on terms of keeping our money local, not paying fees off to Wall Street bankers, that all sounds attractive. Then I contrast in my mind, in my experience, there's a big difference between banking with a credit union and the level of support I get and banking with Bank of America or Wells Fargo or Chase, right? Their apps run more smoothly. Their call center picks up the phone 24/7, all that stuff.
The reason they are able to do that is because when you get a certain size, you can leverage your economies of scale, and you are able to be more of capital intensive business. And with that extra capital, you can invest in the technologies that make things more efficient. The good thing about a public bank is that there's already a significant pool of money that it can have in deposit, which is from the government. So if we did it here in the state takes about $35 billion in taxes and fees every year and deposits into a bank. So already, right off the bat, if we started that, we would have a very significant regional bank that we kind of will into existence overnight if we were to establish a public bank here in the state. Doing that means that we could have because we could leverage those economies of scale, we could be more successful and investing in some of those convenient technologies that make banking experience easier for consumers. And then we could pass that on to kind of the regional banks or credit unions or however way we want to organize it. The other aspect, though I would argue is even more critical, is ensuring that capital gets to areas that is most necessary. There is some economists who have, through their analysis, have determined that one of the things that really slows down a economy is decreasing the number of banks that exist in the economy. A famous economist named Richard Werner, who studied the Japanese economy after World War II and China's transformation from a extremely poor country to now the second largest economy in the world. What he really argues is the reason that the transformation was possible was because both those societies really had robust public banks and really fostered a lot of public banks. In the China model specifically, China was trying to avoid some of the pitfalls that happened on the Soviet Union and still maintain their essentially communist system. And what the central planning of a communist system really has an advantage of is engaging in high-level infrastructure investments. So the Soviet Union was really able to transform and have a lot of economic growth initially because they were paving roads, they were building factories, a lot of that stuff. What's very difficult is for that economy transition to more of a consumer-driven, providing a lot of consumer goods and able to also integrate itself with the world economic system. One of the reasons that China has been able to avoid that, even though they have a good portion of their system still under state control, is China, unlike the Soviet system, which really had very, very few banks and they're all very centralized, China has a lot of banks and they are very decentralized. So the banks all go down, to the local level. China has more public banks than any other country in the world. And because of that, it's very easy for them to allocate capital where it's needed. It's very easy for them to engage in industrial planning. It's very easy that anytime the economy starts to slow down, they can increase their lending to help it speed back up again. And it's been successful in them growing the way they have. So from that, a lot of people have concluded that one of the reasons that, especially since the late 1970s and all the way up to the current days, the decades, the 2020s, that we've had such anemic growth in the United States is because we've developed a series of policies where our banking sector has capitalized itself, and we have fewer and fewer banks. We have less capital, we have less credit circulating, and that has kind of inadvertently really has our economy to really struggle, because capital is not getting where it's needed, and then institutions that are flushed in money, like the Bank of America, the Chase, they're attracted to the financial sector. They're not attracted to the things that we know that are tangible to help the economy grow and build.
So one takeaway, and there are many, you're making many good points, but public banking is not a new idea. In fact, it's well tested and widely distributed around the world, and there are good examples of it within the U.S. You mentioned China and Japan, but there's also Costa Rica, there's Germany, and then right here, the Bank of North Dakota that you're mentioning.
Not only is it not a new idea, but it originally started out as a uniquely American idea. Public banking was initially referred to as the American system of banking, because they wanted to distinguish the American system from the British system, and where the British system was designed to charter these private corporations. The most notorious one was the East Indian Company, and that was their system of banking. Our history of public banking actually goes back to the colonial era, where there was some states that tried to establish their own public banks. And one of the things that really galvanized the colonies against the parliament and the king is the king exercised something called royal prerogative, where they could veto any legislation that was passed by the legislator of a colony. And so Pennsylvania, New Jersey, I think Massachusetts were all trying to create land banks. So banks where the assets there'd be some type of real estate to collateralize the assets, and the Parliament of the king exercised royal prerogative and ended those institutions. And it was one of the galvanizing things, saying, hey, we're better off separating. This fact is known. Adam Smith actually talks about it in Wealth of Nations, and Benjamin Franklin was a fan of the idea, wrote a pamphlet supporting it, saying, hey, we should look at this as a way of helping our nation. This seems like a good idea. After the revolution, the country was so devastated because, it was not a well-developed country, and they just fought a 9-year war with the largest military power in the world. And there was a lot of people who are fighting, being soldiers instead of having farms and whatnot. So the country was really economically devastated. And there was a recognition that we had to find some way to get the country on track. And it was extremely in debt. And one of the things that did that was there was a public bank that was chartered by the United States under the vision of Alexander Hamilton, the first bank of the United States, where, individual investors could buy stock in the bank, but a plurality of the stock was owned, majority of the stock, single largest share of the stock was still owned by the federal government. And that institution for years was really pivotal on having us recover after the Revolutionary War, because it was able to get lending to where it needed and produce economic growth. And everyone who knows about American history knows the fight over the bank was kind of a major theme of, the post-revolutionary era. But I think years on, even though it was very contentious, Alexander Hamilton on one side and Thomas Jefferson on the other, people have realized, Hamilton was really ahead of his time. He was about 100 years too early in his understanding of economics, and realizing, if you have a public institution that can oversee the greater good of the nation, you can really produce a lot of robust economic development that enriches everyone in the country. So, unfortunately, he wasn't as successful communicating that idea to a lot of his peers and his colleagues. So it was a very, very contentious debate, but I would argue that history has really vindicated Hamilton in this regard.
Well, here we are approaching the 250th anniversary of the country, and here we are talking again about sovereignty under various labels: sovereignty, special autonomous zone, soft secession, and the primacy of our financial system is back in the zeitgeist. You've oriented us to the distant history. What about the recent history? Why, given all the examples, given our legacy of public banking, why isn't this just everywhere in the country? And why? And could you ground us in what's developed more locally in Washington State or on the West Coast?
So if this is so great, why don't more states do it? Is the question. I mentioned before, we do have one state that did establish a public bank, which is the Bank of North Dakota. It was established in 1919 when the Nonpartisan League, which was a progressive group, they called themselves the Nonpartisan League because their strategy was to get their members, use the primary system to get their members to be elected in both political parties. And they were eventually successful in taking over the North Dakota government, the state government. And during that time, they created a variety of progressive institutions, and one was the Bank of North Dakota, which has survived for this day. There's been a few other examples of public banking. The territory of American Samoa, they had a situation over a decade ago where, it's a small territory, it's about 50,000 people. So, not that big. The bank that was providing services to the area said it's not worth it. This is a small island area with a few people. We're pulling out, and everyone would have had no financial services whatsoever. So the territory got Congress to allow them to create their own bank. So that's another example. And then the other example, which I think is definitely growing more prominence, is a lot of tribal governments are looking at public banking. Tribal governments are limited from a lot of mechanisms to engage in economic development, because even though they are a government, they can't collect taxes. And if they issue bonds like a municipality or a state government, those bonds, the profits on those bonds can be taxed, whereas they're not for a local government or a state government, which are tax-free bonds. So it's very difficult for them to issue bonds in the market and find people who want to buy them. So looking at banking is a way that they can kind of address that issue of sovereignty. This is a way we can reclaim our finances, kind of control where our credit goes to grow our area, grow our reservations. So that is where we've kind of seen sort of this occur in the more modern sense. Why this become, I think, such a pressing issue for so many states to look at is that the backdrop, as I mentioned before, this we've had just tremendous banking consolidation. All right, and this has just really put a huge crunch in the availability of credit. In addition to that, since Nixon's new federalism, especially under Reagan, we've had the federal government pull back on the generosity that it gave up to states. This started to occur under Nixon, accelerated under Reagan, took off under Clinton, and states have just kind of realized, for years we were twiddling our thumbs and just expecting the federal government to kind of fill some of the gaps. I think some of them just accepted, the federal government's never going to show. It's been decades now. We just live in a new area. We have to start doing things on our own and stop expecting that we're going to get some type of makeup on the federal level to help us fill up some of our gaps. So I think those are things that are really attracting the interest of states to try to get these type of projects off the ground, and other things like it. One project that's not a public bank, they tried to get a public bank, but this ended up being a compromise, is in Vermont. They have something called a credit facility, which doesn't put the entirety of the state's deposit into a public institution, but does let the state treasurer to take 10% of the average daily deposit of the state and restructure that into loans for projects around the state. And it's been really successful and producing a lot of affordable housing for the state, So there's a variety of cities, municipalities, state governments that are trying to get these other alternative funding means off the ground. I think the issue is that, there's, a lot of political inertia. The regulatory regime for banks is very complicated. And then also the private banking sector, they lobby against this. They do not like, it's a great irony. And I think it's an indictment of our modern economic system where we've had sort of this intense banking consolidation. So there's so little competition left. Meanwhile, these major institutions say we have to protect competition. That's why the government can't be involved in creating its own institutions, even though if the government did that, it would inject some much needed competition into the market. And so all those reasons, I think, it's very difficult to get these projects off the ground. But nevertheless, there are people fighting for public banking throughout the country. You mentioned Washington, Oregon, California. There's public banking moons in all of them. There's also in Pennsylvania, there's people trying to get a city public bank. In New Jersey, I mentioned Vermont. So you go throughout the country, there's different people, attracted to this idea, and even some really unlikely allies of it. So a lot of people in the progressive movement refer to it as public banking, but this idea is also very popular among the right, where they refer to it as sovereign banking. I wrote an article that was published in Z Magazine a few months ago about Florida, where their treasurer, the state treasurer of Florida, came out and says, hey, we need to create a sovereign bank for Florida. Well, this is something that really would benefit Floridians. We don't like to see our tax dollars end up in banks in New York. So let's create this for Florida. So, this is something that does have a lot of bipartisan support, and people of different ideologies are attracted for different reasons. I will kind of add on to that. There is a national movement to create a national infrastructure bank that's sort of in the model of Alexander Hamilton, to have a mechanism to fund infrastructure in our country. That movement, even though it's overwhelmingly supported by Democrats in Washington, they have had people throughout the country from different political persuasions that, hey, this is a really good idea. Really bipartisan. There are some people who really lean toward a libertarian perspective. It says, hey, if we have a bank that can allocate this capital, maybe we don't have to worry about, we can serve certain needs and don't have to worry about taxes as much. So there are a variety of people from different political ideologies who are attracted to this idea that we are kind of see percolating throughout the country.
Yeah, and I guess what I'm curious about is what will drive things from percolating to a rapid boil. My observation is that the public is tuning into kind of a fiscal disparity between the federal government and state governments right now. On the West Coast, it comes out in the sort of observation about Washington and California in particular being donor states of federal tax. And yet, despite the fact that I think we collectively contribute about $100 billion a year more than we get back, we're actually getting the cuts are getting targeted at us in the big, beautiful bill and other executive orders that we're watching in real time as we read the papers every single day. So it does seem like there's a moment now for elected officials and advocates to really go after sovereign or public banking. And by the way, I think you say, this is a bipartisan issue. I mean, if there was a shift in the presidential administration, I think we could see Republican-led states say, we don't want to be subject to the whiplash of the same kind of with federal withdrawals that we saw inflicted on California, Washington, Illinois, et cetera.
Yeah, I think it's important to recognize that, the one state that really practices this and is really as a model is North Dakota. And there is a state that now is dominated by Republicans. And the Bank of North Dakota does have bipartisan support, throughout the state. A lot of people really see it as an essential institution to the state's economy. Get into this issue that you have where we have the federal government, we have certain states that are very, very productive, but they don't get things back as much back from the federal government. And the federal government is under Trump is really open about attacking them and structuring the budget in a way that really disadvantages them. That I can understand. Obviously, we understand why that would create so much resentment. But there are very little tools available in our federal system of government that would allow states to kind of overtake their own economy. So our Constitution prohibits states from introducing their own tariffs. The founders were really deliberate about that because it used to be the case that the colonies did do that. And they said, hey, there's starting to be trade wars against different states. And then we think these trade wars are going to end up in a civil war. So let's just have, the only institution that introduces their own tariffs is the federal government. So that's, no state can do that. You can't introduce tariffs on other states' goods. The other issue is that only the federal government can issue currency. So states cannot issue their own currency. Again, this was to make sure that, to create some stability to the financial system so that you didn't have wild currency fluctuations and didn't have, rapid inflation and a collapse, which was something that, people really feared at the founding of the country. So you can't issue your own currency. You can't have tariffs to control it. You can have, your own taxes too. You can do an income tax or property tax or sales tax or stuff like that. But you're really limited for controlling your overall money supply because you don't have sovereignty over your currency. All right. And it's not like you control exports and imports because you can't control tariffs. Well, what is one thing that's available to you that really could give you some control over your money supply? You can control your credit. You can control the availability of credit, and you can do that by establishing a public bank. If you establish a public bank, you can leverage your current deposit to create credit for into your state. And you could do the thing what the Federal Reserve basically does with interest rates, is that when the economy is too hot, they raise interest rates to shrink the amount of availability of credit to slow down the economy so you don't experience hyperinflation. And then when the economy is too sluggish, too slow, well, you lower interest rates and you try to increase the availability of credit. A state public bank could do the exact same thing. They would just have much more tools because rather than just controlling interest rates, they have control over the entire institution to do it. So this is something that states really could adopt that would give them a lot of resilience against anything that's happening on the federal level or anything that might be happening internationally. It is worth noting that Bank of North Dakota is one of the few states that was really protected against the 2008-2009 collapse because they had so many banks and they had the Bank of North Dakota there not engaging in some of the shenanigans that led to the collapse of others in banks. And they had some, basically some sovereignty, some protection against that system. Also, there's some articles that come out is that Bank of North Dakota is shielded a bit from the economic chaos that we're seeing to emerge from the government shutdown, because the bank has kind of signaled is that if things get really dire, we are willing to give short-term loans to federal workers in our state to help them through until Washington gets its act together. So these are all tools that could be available to us in Washington if we started a public bank. I will add, in addition to that, North Dakota has some programs through its bank that very much cut against some of the cuts in the One Big Beautiful Bill Act that was passed that a lot of states are nervous about. So One Big Beautiful Bill cut student loans, the availability of student loans. Well, North Dakota Bank offers student loans, so they can compensate for that. The One Big Beautiful Bill cut clean energy projects, funding for clean energy tax credit. Well, a few years ago, the Bank of North Dakota started offering very, very generous low-interest loans for clean energy projects in the state. And it's been very, very successful. And they can protect themselves against that. And they're still seeing, a lot of investment in clean energy. It's an oil state, but they're seeing greater investment in clean energy because of that. So yes, establishing a public bank would make states give them to be more nimble around their own economy, be able to structure in a way that works for their state, and provide them with more security to any of the turmoil that's happening in the rest of the economy.
I really appreciate this framing of resilience and adaptivity, which is a different, related but different notion than sovereignty. The idea that with more local agency, we can stand up for and support the priorities that we set locally, and apply capital to the challenges and opportunities that we identify locally. So I think what to step back a little, you're saying, hey, public banking, the sort of state sovereign toolkit includes consumer public banking, business public banking, infrastructure, and government public banking. Are there other tools that states would be wise to evaluate in terms of building financial resilience and independence? For example, we hear a lot about sovereign wealth funds in certain parts of the world. Is that a tool at the disposal of state governments?
That's something that some states can engage in. It's a little bit more difficult here in Washington because our Washington Constitution would prohibit that. So might need some type of amendment. Our Constitution has a clause, which a lot of states have, but we have it understood in a very strict sense, which is called the prohibition of gift of public funds, which benefits the state government and any municipalities or county governments from lending private credit or investing in private business, unless, and there's, some qualifications in the government. So, unless the program is explicitly to benefit, poor and infirmed, or it's something the courts have decided is essential government service and the government, has to provide it to basically have the standard of living that we think is typical for, that you would have under any type of government. But it really restricts stuff that, but other states that have as less of a strict interpretation of that or don't have a clause like that can do a sovereign wealth fund. Another tool they have is that states can kind of pick up their regulatory function. We've seen this with administration has really attacked the Consumer Financial Protection Bureau, which is an institution that was created after the 2008-2009 collapse as part of the Dodd-Frank legislation that has a federal agency that is there to make sure that people are not being ripped off by financial institutions, financial structures. So they regulate credit cards, look out for a lot of fraud. They see if banks are doing some nefarious practices, Like one of the things they really initially clamped down, which banks were really frustrated by, was overdraft fees. Now, if you have a bank and you have an overdraft fee, you may have made a series of purchases, realizing you don't have a lot in your account, and you're like, oh, I'm going to hit an overdraft fee. That's okay. I know that this last purchase does it, and this last purchase is only a little bit. And then you get the fee, and the fee is much larger than what you thought. And it's like, I thought I only made one purchase on that. Well, what was found out is the banks, and within a day, would rearrange the order of your purchases and do it in a way that you would max out on your account much earlier and then would have to pay multiple fees rather than one fee. And the Consumer Financial Protection Bureau came in and says, no, you can't do that. You can't, rearrange the order of people who have done purchases within a day just so they have to pay more fees. So that's one of the, importance of an institution like that, playing a watchdog. Well, that institution, like I mentioned, has been very much attacked. It's being hollowed out. So a lot of states are kind of stepping up their game and saying, hey, we're going to start building up our own, the states have like a Department of Financial Institutions or Financial Services, something like that. They're kind of working out trying to build those up to fulfill the role of the Consumer Financial Protection Bill that's been created by the attack on the Consumer Financial Protection Bureau. Another thing states are looking at, and New York has really been a leader of this, is regulating Bitcoin. So New York has a bit license where you have to get a special business license before engaging in Bitcoin. And Letitia James, their attorney general, has come up with a recommended additional license to regulate Bitcoin and cryptocurrencies. Another thing is that states are looking at clamping down on credit cards and how much credit cards charge for impact fees or late fees. So all these different ways that states are working to kind of regulate the financial sector in the interest of their residents. But all these things, I would say, are also very contentious. There's a lot of court trials, a lot of court cases, and there's definitely a big fight going on between states' willingness to exercise their sovereignty over the region and regulate the financial sector, and then major banks, credit card companies, cryptocurrency companies, all of them fighting it out in the court and trying to say, no, we don't think you have the authority to actually regulate us.
Yeah, so you're highlighting that while all different political persuasions could kind of arrive at the merits of an idea like public banking, there's incredible complexity associated with it, and the fact that we're dealing with federal rules and state rules that are all may have been rooted in good instincts at one point are now kind of standing in the way of rolling out anything innovative, and then you get private interests that are going to try and protect those interests. So it all adds up to a hard change to bring about.
Yeah. Banking is one of the most regulated industries in our economy. And a lot of that regulation makes sense because you basically, like I said, banks are in the business of buying and selling money. And because they're in the business of buying and selling money, they play a major role in the overall economy because the money supply can really determine the health of your economy. But some of those regulations really arguably advantage some of the bigger players and make it difficult for smaller players to compete, and make it difficult for innovative institutions like public banking to get off the ground. So that's something that we struggle with in the movement to try to find clever ways around that. In addition to that, though, our banking sector is not one that has always been well planned. It's one that has really haphazardly evolved over decades, and you look at sort of the layers of different financial institutions on top of each other. And it really is, quite a mess. And it's very complicated and convoluted. You do get a system where there's a major crisis. The government tries to respond to the crisis to create sort of a new layer, new way of doing it, and another one to another one. And, there's not a lot of overall structure that is very elegant and coherent. Everything is made out of compromise and, just reactiveness, which I will say, is pretty common in a lot of political systems. But, because we're such a large country, we have a very elaborate federalist system. I think it's maybe particularly difficult here in the United States. So all those things do present real challenges to trying to imagine new ways of organizing our financial sector and trying to move from the state that we have now, which arguably is not working for people, to a future state where we really would start moving credit to social needs and working to uplift Americans.
Are there moves available that could fly above some of this complexity? I mean, one brainstorm I've had is, what if California or the Pacific Coast coalition of states offered crypto coins that were social purpose driven? You know, a coin offering for housing or a coin offering for climate remediation that's backed by the assets of those states and has a very specific, kind of targeted use. Is that in the realm of reason?
It is. It's in the realm of reason, and it's due to the Genius Act that passed Congress. It's in the realm of possibility, where states could start introducing their own stable coins, which are crypto coins that are backed by certain assets. So the value of them should be stabler than other cryptocurrencies. States could start doing that. There is some complications with that. One is you do run a risk of, if you have all these states which own their own stable coin, you do run a risk of either kind of experience hyperinflation or really difficulty trying to do with exchange rates. And when the country was first founded, there really was a discussion if states were going to introduce their own currency. And there was a movement to try to states introduce their own currency to deal with some of the debt that especially farmers had accrued during the Revolutionary War. And the founders decided, no, we're going to have one currency throughout the whole country. And it's going to be, the only institution that's able to determine that is the federal government. And it really wasn't until after World War II that we had a stable paper dollar not World War II, after the Civil War, I meant to say, where we had kind of a unified system of currency issued by the federal government with greenbacks and that Abraham Lincoln introduced as a way of stimulating the economy to help pay for the war effort. There are some barriers, there's some things of caution to be concerned about if all the states started introducing their own stable coins. They could do it. I think it's questioned if it would be legally challenged, but hypothetically they could do it because you're not necessarily being a currency. It's a stable coin, you could argue, but you do have to deal with the mess that it might create with, competing exchange rates and the possibility that some states may experience hyperinflation or if they really invested in their stable coin, then they could be vulnerable in some regard. The example that we kind of have, the modern example that we have of this is the transformation of the European Union, where you had all the European states having their own currency. And they said, hey, this is kind of a mess where some states are very vulnerable. We're going to switch to a single currency. So they did that. But then the way they structured it, they didn't really create a sort of a democratic federalist system. And they put really restrictions on the availability of the euro. So one way people have looked at it is that by creating a currency for the entire European area, European Union, they've kind of went back to be on the gold standard where they've really shrunk the availability of their currency and make it very difficult for the centralized European institutions to pick up some of those institutions that are very, very dire, which wouldn't happen in our system because of our federal system, because it's easy to access Congress, easy to make changes, much more so than the European system. They've traded one, bad scenario for another one. We don't want to have a situation where we do the same thing. So cryptocurrency, stablecoin, they provide some possibilities for states, but they also come with some dangers that, we'd have to be aware of and probably think of if we were going to go that direction, we have to think of some clever ways to mitigate.
What's the right way to think about scale when it comes to public banking? Would we be well served for the 3 West Coast states to join forces? Would it be better if LA County, which outnumbers most U.S. states, for them to do their own thing, for King County or Multnomah County and Oregon to do their own thing? Or is there a magic formula around the right size for doing something impactful with public banking?
No, I think is a great question. It's a great question to ask in a variety of contexts, not just with the economy, because there are certain trade-offs. If you have a very, very large institution, you can create certain efficiencies that's not possible if you break everything down to, their own individual unit. You can create economies of scale. You can ensure that there's a level of cooperation that wouldn't exist otherwise. However, if you have a bunch of smaller institutions, you have a greater possibility that those institutions could respond to local needs, and they could provide, the phrase is kind of laboratories of democracy or alternative policy ways of doing things to see if they work that, eventually other places could duplicate. So the question is, how do we manage that? We live in a federalist system, and the federalism is kind of the ways of trying to get the best of both worlds. It doesn't always work, but that's kind of the idea. Is like we're going to try to do this to get the best of both worlds. That concept is really kind of integral into how we think about financing throughout our political system too. So, for example, like we have the Federal Reserve, which is a banker's bank, but the Federal Reserve isn't a single centralized institution. It's actually 12 regional banks that are all supposed to serve a particular region. And then kind of, we have sort of a balance between those regions and the federal government. And that's really how we thought about them. So if it would make sense for a lot of cities to have their own bank. And then if you have a state institution that's also a bank, that bank could help out those cities, and you could have it move up and down. The money could trickle both ways to help those institutions. So ideally, that's probably how it would work, that you can guarantee some type of cooperation, some type of economies of scale, while also offering some type of variability and some type of local control. If you were to create sort of a financial zone between Washington, Oregon, and California, that was really formalized, that would probably take an act of Congress to do. So that's something that you have to be aware of. If you want to create sort of interstate institutions, you do need the consent and the willingness of Congress to establish that. If it's less formal, and there's not sort of explicitly that institutions going to help, like a lot of things with the states are coordinating their vaccine regimens, those are all recommendations. So it's not something like we are creating a medical board that's going to go across all states, things that we're just sitting down, talking to each other, seeing this is what works. And so we're all going to kind of agree to be on the same page about things to help moving forward. But it's not necessarily as legally binding. That's fine. You could do that if you had a bunch of states kind of create their own banks, they could kind of cooperate with each other financially. But to create an overall institution, you would have to create some type of movement within Congress to sanction that.
In our waning minutes here, what are headlines you would love to see 5 years hence about public banking and public finance in general?
Well, we have a bunch of, like I said, we have a bunch of movements across the country. So in the 5 years, I would like to see them get off the ground. I would like to see a public bank established in Seattle and Tacoma and other major cities in Washington. I would like to see the state legislature establish a public bank. All those things I think would really go a long way in rejuvenating our economy and investing in the things that people want to see. You talk to anyone on the street, you're like, are we doing enough to provide housing? They say no. Are we doing enough for infrastructure? They say no, these roads are horrible. Are we doing, what about transportation, light rail and all these things? Like, no, it's, and one of the major bottlenecks is the financing. So getting those off the ground really would help us to make the investments that we want to see happen in the economy. On the national level, I would like to see projects like the National Infrastructure Bank take off. As that project designed, that would have $5 trillion, not billion, but $1 trillion available in infrastructure in our country. And again, that's an institution that has precedent. During the Great Depression, they created the Reconstruction Finance Corporation, which basically was a national infrastructure bank that made loans to help the country climb out of the Depression, and was pivotal in seeding the industries that allowed us to transfer the economy during World War II. Unfortunately, the problem is with all these institutions, Congress has a habit of chartering them for a specific date and then not renewing them and having them just die off. And then things go bad and they come up again and they do it. We had the first bank in the United States, the second bank in the United States, the Reconstruction Finance Corporation, again and again. We had postal banking for a period in this country. Congress kind of has this delusion that it's out of the woods and it can deal without these institutions. As soon as they get rid of them, we see major downswings in the economy where we struggle as a nation. So I would like to see sort of the wisdom being like, no, if we want to create these institutions, we want them to be pillars of our overall system of political economy and exist in perpetuity to function to build up the standard of living for all Americans. That's what I would like to see, sort of the transformation to happen in our country.
If Jefferson and Hamilton could look at America today, they'd recognize the debate we're having over concentrating or diffusing financial power. Who decides where wealth and government investment flows? Who benefits from the labor and taxes of the people who create it? In the country's early days, the battle was over whether to build a national bank. Now it's about whether states and regions can reclaim the tools of investment to fund resilience, housing, and infrastructure for themselves, without waiting for Washington, D.C. to fix itself. That's just folly. Public banking isn't about ideology, it's about ownership. It's about ensuring lending and borrowing happen here, and that interest and fees stay local rather than lining the pockets of big banks and Wall Street. So what if the West Coast truly banked on itself? I'm Greg Amrofell. Thanks for being with me in Pacific Time. Please follow, like, and share this podcast with friends, family, colleagues, and neighbors who care the way you do about the West Coast and understand that greater financial independence isn't just nice for each of us personally, but a growing imperative for our region. Whether you're a business owner or working stiff, what would you want to see in a state or city bank to leave Wells Fargo, Bank of America, or Chase behind? Remember to subscribe, like, and share at Pacific Time on YouTube. Thanks, and I'll see you next time.